Our guest says the bond vigilantes, that's investors who tend to sell government bonds when they're unhappy about government deficits, are in charge, and not just in the US market. Let's get more from Andy Brenner, head of international fixed income at Natalliance Securities. And great to see Andy, as ever. And of course, the bond vigilantes have also been known to short bonds when they think governments are in over their heads with spending. And you think that's a theme in the market right now? The capital markets are telling governments your deficits are too big?
Yeah, we're seeing it globally. I mean, generally, it's been more focused on the U.S., but in the last week, we've seen selling out of Japan, which has been significant. We've seen selling out of France, and we've seen selling in bunds, selling in the U.K. I mean, it's not a Liz Truss type moment, but it's certainly a pushback. Yesterday, we had long bonds, 30 years, get to as high as 515, something we hadn't seen in a couple of years. And they held there, and then they rallied towards the end of the day when we saw some short covering, some duration extension, and some outright buying, and they got all the way down to 502. And then this morning, with the Trump, blasting of Apple and blasting of the EU, as your other guest said, someone got up on the wrong side of the bed. We saw the long bonds get down to like 497, 496, and they're back above 5% now. So you do have the vigilantes. They are very much involved. They're very unhappy with the deficit spending across the world, and they're going to make a push. On the other hand, you have real asset buying that likes the idea of getting 5% yields.
Is that bad for stocks, though, a 30-year at 5%? Will it tend remorselessly to suck money out of the equity markets?
You know, I don't think that's the level that does it. I mean,
Okay.
first of all, I kind of follow Mike Wilson from Morgan Stanley, who was saying the other day in a meeting that 4.5 to 4.75 equities are still good. So, and that means 10 years. So if 10 years were to get above 4.75 and get on the way of 5%, yeah, then I think it would be a problem for stocks. But you know what? Historically, 10 years have been something in the order of 4.75, 4.80 over the last 50 years on average. Obviously, we've seen them down to 50 basis points a few years back. But that is the average, and I think we'll be able to get through that. I don't think it's terrible. What we have seen is a lot of house closings people have backed away because mortgage rates have gone up. So I think there is a problem there, and I do see a topping of U.S. rates in the very near future.
I'm just looking at TLT, which, as you know, is a 20-year bond ETF in the United States, widely followed. It surged during COVID. It peaked there in 2020. People were desperate for a harbor. It has drifted down, but it hasn't done too badly over the past 2 years. So recently, I know we've seen bond yields go up, which means prices
TLT's gone down.
Yeah, but TLT hasn't been too bad over the past year or two.
No, that's right. I think that, you know, it makes sense. We've been in a range, even though we hit new high yields in the long end in the last 24 hours. I don't think we are going very much higher than we've been in the last few years. And again, I think that 5%, or as Rick Reeder likes to say, getting 6% in corporates or even 6.5% isn't a bad place to put money. Again, you know, that does take money away from equities, but I think equities are okay right now. We saw yesterday one of the largest options trades where someone got very bullish on equities for the end of June, and he put in as much as $3 million, according to a Bloomberg story, in buying equity calls. So someone's out there who thinks that we're going to go much higher in equities. I'm not of that strong opinion. I look at things on a month-by-month basis, and the sell in May and go away hasn't been a good strategy. So it looks to me like, you know, selling in July makes more sense. In August and September are the two worst months for equities of the 12 months of the year. So I think we still have a little bit of room to go to the upside before we have some kind of correction going into the fall.
I know we're straying into politics, but is there much prospect that the Senate will significantly change President Trump's tax and spending bill?
Well, if he does, I mean, the House only passed it with a 216 to 215 version, so it doesn't seem like there's a lot of flexibility there. So I would tend to think that the Senate won't do that, but anything can happen. It could go back. It could be no budget. It could be a different budget, and so on and so forth. But I tend to think it's going to be pretty much as the House, who really had to negotiate for a long time. I think it's going to be close to what the House has put forth.
Maybe we can put up a 5-year chart for the US dollar. Where do you see that going, Andy? And I know that's a very broad question, but is the US dollar likely to weaken with this supposed flight from US assets?
I think the dollar's got a little bit more downside, but in reality, you know, when you start talking about, will the dollar lose its status as reserve currency, I don't really see who's going to replace it. I like to use the analogy that we're the least dirty shirt in the laundry, and the dollar's going to maintain its reserve currency status. So yeah, it could go down a little bit lower. The euro could get up to 115, maybe even 120, but I don't think it's going to go much different than that. I mean, the Chinese had the best opportunity to be the world's reserve currency, but they won't let their yuan float, so that takes them out. The yen has no chance of being the world's reserve currency. So I think the dollar will remain the world's currency, and I think 80% or 82% of all the activity is done in dollars, and I don't see that changing anytime soon.
We're hoping to talk to Chris Whalen, the longtime financial commentator, an author on Monday. He has a new book out, and he argues that, sure, the US dollar will lose some of its status as a reserve currency, but what's the alternative? He says you can't just trust the Chinese regime, for example.
No, as I said, whether you trust the Chinese or not, if they're not going to allow their currency to float, and they're always intervening one way or the other, you can't have them as a reserve currency. Sure, you might be able to do it with the BRICS, you know, with Brazil and with Venezuela and some of the countries that really, you know, don't really like the dollar per se. But as far as a world's reserve currency, not even close. The next alternative is the euro. But even though the euro is being loved by everyone right now, I mean, the work ethics of the European Union are just not positive in our view. And we don't think the euro, it's too political. 27 countries, you know, all involved. So we don't really see the euro as the substitute for the dollar.
Andy, always great hearing from you. Thank you very much.
Have a great weekend.
Andy Brenner, you too, head of international fixed income at Natalliance Securities.